other questions, comments? Otherwise, thanks so much. Thank you, Brian, for all your hard work. Appreciate it. All right, we are going to look at private equity in our portfolio. This is also something we've requested, the Vice Chair of Investment and myself, Mr. Rosensteel. And so we have our new private equity consultants, John Haggerty and Steve. Go by Steve or Steven?
Steve is fine.
Steve, okay. So we've got Steve Hart and John Haggerty from Makita, and we've had a couple phone conversations, and we've got our, I guess, Stephen, you're the general consultant role and the private equity consultant, to review and take a look at our private equity portfolio. So this is also an information item, so take it away.
Great. Well, we're pleased to get started with you officially.
Yeah.
And we've been doing a bit of work behind the scenes up until now, and hope it shows. So at the last meeting, we were asked essentially for two things. One was a public market equivalent analysis, and we'll deliver that with this presentation. And second, we promised that we would go through a number of what we called best practices, and you could choose any number of best practices to focus on. We picked 5 that we felt were particularly topical, and only 2 of those, I would say, are worthy of extensive conversation, and we'll go through those in a bit. So the 2 parts of the conversation will be led by myself and Steve. The major conclusions were positive. The private equity program generated $13 billion extra dollars over having invested the same capital in the public markets since the inception of the program. And the 2 major findings from our review of a handful of best practices are listed on this slide, which is the program may benefit from a more formal process for pacing studies, and lastly, to consider giving more resources to co-investment program. And we'll get into those in more detail. But first, we'll get into the public market equivalent analysis, and Steve will do that.
So this page here is just a quick overview of the program as it sits as of June 30th, 2015. So just the quick numbers, about $15 billion has been committed to private equity since inception in 1989. You have made about $41 billion of contributions and received back a little more than almost $45 billion. And the remaining value is just under $20 billion. So in terms of the rate of return, you've seen from other reports about a little over 13%. And what we've done is kind of broken it down into the different subclasses to see kind of an engaging size. Buyouts is certainly the largest, followed by distressed debt, equity expansion. So the public market equivalent analysis, this essentially is trying to see if you had taken those $41 billion of contributions and instead invested it into public markets, where would you kind of be today? And there's different ways that is kind of done, and there's no kind of real one way to do it, but we tried to make a way to make it clear where this returns have come from, and try to scope out the size of what that would be. Let's see, I guess the last point here is that the public equities, we'll talk about this a little bit further, the public equities are not a perfect discussion of what the risks and issues are in comparison to private equity. But when thinking about what the alternative would be for that capital for going into private equity, a public equity is a good comparable for that. And obviously that's what you are using in your long-term benchmarking for the private equity program is the Russell 3000. So we talk in the memo quite a bit about the methodology that we have used in that, and I'm happy to talk about that in more detail, but just trying to make sure we move this along. Essentially, what we have is looking to create two portfolios. One is if you'd taken all those contributions you made to private equity and instead invested into public equity, what would that be worth today? And then on the other side, take those same contributions that you made to private equity And when you have received a distribution from private equity, what you have done with that dollar of capital is you'd invest it into a public equity index, and then you're rolling all this up together to June 30th, 2015, and you're just kind of comparing what those two portfolios kind of look like. And so what we did here is showing against three different indices, the S&P 500, the Russell 3000, and the ACWI index, taking those $41 billion of contributions in each of those indices, and that second line down, the total PME value. So just looking at the one for the Russell 3000, showing that that would be worth, as of today, $85.8 billion. And then what we're doing is comparing that with the ending value of the program today, which we'd seen before is just under $20 billion, 19.8. And then we've taken all of the cash flows that you've gotten back, all the distributions you've gotten back from the private equity program, and then reinvested on the days you got it into the, in this case, the Russell 3000 index. What would that be worth today? And that's just under $80 billion. So a total value of your private equity program, $99.4 billion. And that, if you compare that to what those contributions would have been worth had they been invested in the Russell 3000, the outperformance that we're calculating through this methodology, $13.5 billion. So this is just a page describing that. Then what we wanted to do is to try to go into a first cut is showing where did this outperformance come from? Where were the main contributors to that in your program? So again, taking the total fund, this $51 billion, the $41 billion of contributions, and breaking it up into the different portions of the private equity, the buyouts, equity expansion, et cetera. And then also breaking out between, taking that same $51 billion commitments, breaking it up into fund investments versus co-investments, breaking it up between those investments that we have seen have been fully realized, meaning that the ending value as of June 30th was 0, so there's no residual value there.
Steve,
So we're just kind of showing all those different cuts to it. And
Steve, I've got
where
a
this
board
go-
member question. Sorry
Sure.
to interrupt you, but I didn't know when to get in there. So, Tom?
Can I back you up? When I reviewed the material before, and I may have missed it, but I don't think so. I don't think while you've come up with a very large absolute dollar amount, given the length of the program and the amounts of money involved, what does that do what does that say in terms of incremental IRR or percent return?
So this calculation, what we set out to do from the instructions from September was to calculate the dollars of outperformance.
Yeah, no, I get that.
Right.
Yeah, from previous reports, the IRR of the public markets index, depending on which we're looking at, is in the neighborhood of 8 to 9%.
Right.
So the difference is 4 to 5 percentage points annually.
Yeah, it's just I would have thought that the absolute dollar number would have been larger for that to be the case, and it must be that the dollar amounts in the earlier years were relatively small.
That's correct.
Okay.
Yeah, there's, as you can see, the program, it was, on a total scale, there's a lot of the contributions have come in the 2000s.
Okay.
And
And just
center
sort of
part of the 2000s.
Prefacing a set of questions I'll have later.
Sure.
We're previewing. If you looked at the last 5 years, the outperformance in dollar terms and IRR terms would be what?
So we have a chart that starts to address some of this, and we've got some comments around that. So we can
Should
get
I
that.
just wait?
Just a couple of slides, and we'll get there.
And let me just get Frank in here as well. Frank?
What's the explanation for why the proactive portfolio is the exception compared to the other segments? Why is it negative?
So we haven't gone through to kind of further dissect inside the proactive portfolio. You see there, it's about $2 billion of commitments. It's a mix of investments that are there in terms of the different strategies. One major portion of it is into fund-to-fund investments. So there's two aspects to that. One is an extra layer of fees, and the fact that that gets deployed a little bit more slowly than investments in a fund directly. So one of the things that we want to do in sort of further analysis is what we call an attribution analysis, to try to understand within the portfolio what have been the areas that have contributed to the outperformance. Has it been vintage year? Has it been strategy selection? Has it been manager selection? Try to understand those aspects of it. And that's just not what we've done just yet.
Can I jump in behind you, just knowing the history? Part of it also, I would totally agree, for the proactive portfolio, it's the fund-on-fund strategy, which we knew going in. And the proactive portfolio is the name of it in private equity. It's the same thing as the emerging manager portfolio in global equity. These programs are designed to invest in the urban and underserved parts of California, or with new and next generation first-time equity managers. It suffers from the structure, which we understood going in would be a weight on it. Also the time period. We started this in about 2003. That's no excuse. The portfolio still has not performed. Of those new early managers we funded, only 2 out of 10 have done well. So it is something we're going to take a look at, but it's part of, and the subcommittees looked at this. It's part of the challenge of investing with emerging and diverse managers. I think what I have said publicly to the different affinity groups is, our experience has proven is that active management is in fact hard. Paul's right. It's hard. And it doesn't matter whether you're a white male or female or of a different ethnicity. It's just plain hard. And in our emerging manager programs, unfortunately, in almost every asset class, have really had a tough time. And you'll see more about the emerging manager program. Our 5-year business plan is up. We're due to renew it, so we're going to come back and talk a little bit about what we've done for 5 years in April, and then need you to adopt a new long-term business plan for diversity in June. And it will be part of looking and dissecting the results of these, because we're all very disappointed in the results. They are not as people promised they might be.
Thank you.
So I'm going to move on if there's no further questions on this page. So we did do a further analysis just to try to look at the fully realized investments here, and this was a slightly different analysis in that what we attempted to do first was just looking at the portfolio that had been fully realized as of June 30th, 2015. But we also, in terms of the methodology, it was talked about in the memo a little bit, but basically what we did is to not reinvest the distributions in from the private equity portfolio. Instead, what we did was to reduce the value of the public portfolio where the individual contributions were put until the point where that reached zero, and then calculate any additional money that was distributed by the fully realized portfolio. So the idea here is to try to isolate the effects of having that contributions of the distributions from the private equity portfolio into a public program, and having that value of that sub-portfolio be impacted by how public equities do. So here it is the numbers on this, in this particular case, showing a additional value from your fully realized investments of a little over $4 billion. So another sort of ways of trying to assess and understand the value that's been realized in the private equity program. So Tom, this relates
can I
to a little
just-
bit to your
Hang on.
question.
Just-
Yep, sure.
So, we talked about this earlier when reviewing the work you were doing here, but part of the difference between these two measures is that the first measure says whenever there's a distribution, then there's a similar investment into the public market. So in a sense, because the market has been rising, the market rise has magnified the benefit of private equity, even though it really wasn't as a result of private equity. In other words, let's say we invested in private equity from 1995 to 2000, and we invested in public equity from 1995 to 2000, and at the end of that 5-year period, the investments have matured and all of the money is distributed, but there's 10% more that we have invested in the public markets because of the private equity performance from 95 to 2000. Then because the public markets did well for the next 15 years, that magnifies the difference. That magnifies the benefit. And that's what your earlier number incorporated. There's no perfect way of adjusting for that. And in a sense, maybe it shouldn't be adjusted, because the fact that we had more money at the end of 2000, now that means we've got even more money at the end of 2015. But maybe that's not completely attributed to private equity. So the second number is an attempt to try to adjust for that, but there's no perfect way to adjust for it either. So neither number is kind of complete and right in and of itself. There are two different ways of adjusting for sort of an incomplete methodology to tell the full story. Is that?
That's absolutely right,
Okay.
Paul, and I agree with that. And I think what we have said, that there's various ways of going about doing the calculation. $13.5 billion is a number based upon certain methodology and calculations that it's not necessarily right or wrong, but it is a way of looking at it and trying to show. So based upon that methodology, that's what the number is. I think the larger picture is that private equity has been additive to the program. And then we're trying with these different methodologies to try to get a feeling around what the size of that might be.
But part of that is sort of an answer to Tom's question,
Exactly.
why the benefit looked so large. Part of it was that it then got magnified over.
Well, yeah, but the other alternative is to reinvest in private equity.
Right.
And you get better.
Yeah, absolutely. But so it just reflects that there are two different ways of measuring it, neither of which is ideal, but both of which are ways to get it to today.
Yeah, you could also reduce it to cash, but
Right.
equity returns to cash too. But I mean, I think they did a fair job.
No, absolutely. There's no question. I don't disagree.
Okay.
So this page here, what we looked to try to do a little bit was to Tom's question. The idea is to try to understand the persistence of performance in the program, not of individual managers. But so what this chart shows is a rolling 5-year IRR. So taking the private equity portfolio in the blue line, what the IRR return was from the date 5 years before, let's say December 2095. So from 1990 to 95, what the IRR was, and then compare that to a PME portfolio, which was composed of 2/3 of Russell 3000 and 1/3 of the ACWI, to try to get some currency and non-U.S. exposure in there, and looking at what that IRR of that portfolio would have been. So, and that's the red line. And the idea there is showing generally that the private equity portfolio has outperformed that public equity portfolio on a pretty consistent basis over time. It's been somewhat less volatile, it appears. We didn't run the statistics, but just looking at the line, it's less squiggly. And then to the point here, going from basically from December 2011 through more or less today, the private equity and the public equity index have been almost the same. And part of that has been driven by, obviously, the public equity markets have had a very strong rally since 2008. Additionally, there's quite a bit of capital that has been deployed in the private equity program over the recent years. That the participation in private equity in the 2009, 2010 vintage years was relatively low, and those turned out to be very good vintage years. There wasn't a lot of available assets, but that's been pretty good vintage years. So we're going through and looking to do more vintage year analysis to understand what has been driving the returns more recently. What we can see is that those vintage years, sort of from 2000 through to obviously 2015, are immature. You've got less than half of your value returned out of those contributions just yet. The rest of it is unrealized. So it's unclear exactly where those returns are going to come out. And we're looking to try to understand more of what's in that portfolio to be able to understand what the more recent vintage years are, how they're performing.
You know, it's a qualitative question I've had for a while. So it's something over time we'd like to know your point of view on. But I think the question on volatility is driven by two factors. You know every day what the volatility of the public portfolio is. One, we have a built-in lag because people don't mark to quarters. The mark-to-market methodology is quite different in the private equity world, and my guess is goes a lot slower on the downside than it might, probably on the upside too, but it's just a very different valuation methodology. So I'm not sure we're not dealing with apples and oranges when we talk about comparing volatility.
Correct.
And what the real economic impact to the value of our portfolio is over time.
That's right.
The other thing I'd sort of look for a qualitative commentary on is this. I mean, I think people tend to think of the late 80s through, I don't know, some period in 2005 as kind of the golden age of private equity. And the question is, looking forward, do you think the golden age returns? Does the proliferation of funds, et cetera, begin to eat into that premium that we enjoyed over the clearly great period? And it may be impossible to answer now, both on one or both. But, yeah.
So this could be a very long conversation, and I would say very quickly that competition has certainly increased a lot. And this factors into the premium that we establish for private market over public market that goes into the asset allocation studies that we work with our research staff on. So we try to capture that in the strategic planning, and we're ever mindful of what has to be a narrowing margin because of the level of competition that exists today versus 15 years ago. There's no denying that.
I mean, very much on my mind, and maybe I just lived through too much of it, is that the classic time that private equity was just killing it is when you would buy really private companies or divisions of public companies that were underperforming. You could lever them and sell them real quickly. And then as they grew into taking positions in public equities themselves or buying public companies, the returns, I think, have narrowed. And it's a lot harder to find that unique opportunity. Hallmark isn't going to sell its gift card business again or something like that.
So it's a part of our presentation we were planning on skipping, but you can potentially disaggregate that premium into illiquidity effect, small cap, and such. And all of these things may represent more risk that you're assuming to achieve that higher amount of return. That's the flip side of the whole discussion on PME that I don't think we have time for now. It's in our memo, and it's the next section of this report. But there's no denying that there's so many more practitioners of private equity to have a plan to improve a company is something that is very common now, whereas it happened to be just a leverage and multiple expansion game.
Right. Okay.
I have one other observation I just want to make on this chart here, because it is tempting to look at it and conclude that something's happened in the last 5 years. The most interesting part of this chart isn't the last 5 years, it's the 5 years in the late 1990s. It's quite normal for private equity programs to lag public market indexes when public market indexes are up a lot, as they had been for the 5 years running up to June 30th. Your program in the late 90s did not, because you had some really fantastic investments that you had made specific to your portfolio. So normally, if you looked at most private equity portfolios, you'd see a period of lag in the late 90s, followed by recovery in the 2000s, a little more of a lag in the middle 2000s. And so this is really just an expression of how strong the performance of your specific portfolio was for much of this time period. We'll dig into this more with our future analysis, but your experience over the last 5 years is very consistent with that of most other institutional pension fund private equity portfolios.
So we just, these pages were just on what John was kind of alluding to, a number of issues as one compares private investments with public investments. And we go through a number of the points there that one might want to think about to try to get an assessment of comparing risks. And this is just more commentary. It's not qualitative to try to say, percentages exactly, or to say good or bad, but just more talking about it. So obviously talking about a leverage effect, typically the buyout strategies employ leverage, but some of the strategies that you have in private equity have little to no leverage. And of course, public companies have leverage as well. So it's not a full direction one way or another. Private equity tends to invest in smaller companies, and those tend to perform better than larger companies. The quality effect, the private equity companies tend to be less well established, and higher qualities companies tend to perform better. On the illiquidity side, certainly individual investments are illiquid, and if you want to trade those, there's quite a bit of friction with that. But looking at your overall portfolio, there is a tremendous amount of liquidity, and just calculating since 2002, nearly $13 billion has come back in net liquidity in the program. And the topic we just discussed about the volatility, the experienced volatility in private equity, and the fact that in the asset allocation, we have a higher, more representative volatility expectations and return expectations that are lower than what we had been seeing more recently.
I mean, whatever you want to, I think in general, we've read the material, so if you want to just kind of tell us the money shot. I think part of the reason why we originally talked about this too is I think in the past year, the conversation's been around, I've heard the comments about, global or, private equity has sort of, done its job in our portfolio. And I think there was sort of this question around so specifically, how is that true? And if that is true, then what are the metrics or what's the data to support it? So I think, obviously it's helpful to kind of have you guys say yes. But yeah, if you want to.
So this is very quickly in installment one of best practices. Again, there's many that we could choose from. We felt these 5 were particularly topical, some of which you've already covered today and needn't be covered again. But pacing, I mentioned earlier, is one where we have a specific observation, that is to conduct a more formal pacing study that results in a budget for a year or any period of time that you select, and to give consideration to some investment beliefs perhaps that are related to whether you can or cannot time the market, give consideration to whether there should be variability in terms of how much you deploy to vintage years. because there's two things that we really want to bring to your attention. One is to have a delta between your intended target for private equity and what you actually have can have a large effect on what the overall return of the pension fund is. That's obvious. But can we manage, and it's a question really, can we manage that a little bit more precisely and prudently at the same time? And the second issue with that is vintage years have very different return patterns, and so we would argue for fairly consistent deployment of capital over time, and would suggest that we explore ways to examine model outputs and policies and procedures that get to that. The second category has to do with investment level costs. This is an acknowledgement that private equity, unlike other areas of your portfolio, is not a commodity, that there is a spectrum of quality to the managers, and correspondingly there's a spectrum of cost that's associated with that. And our review of the practices of CalSTRS revealed very positive practices. There's active efforts to negotiate with managers. There's a very opportunistic approach to looking at each situation with the manager uniquely and not applying a blanket policy for negotiating across the board, but also keeping costs in their place. So there can be a penny wise and pound foolish effect if one is to focus only on costs. So we're very comfortable with all the efforts that are being made to reduce costs. We will highlight later in this that the consideration of separately managed accounts, which could dovetail with some questions earlier for Steve McCord about opportunistic buckets within a portfolio, and also making co-investments. Currently, the staff is making co-investments, and you can do those at no fee and no carry, and typically at a 20 to 25% IRR, gross IRR. You might receive 500 to 600 basis points in fee savings to do the investment through a co-investment format versus through a fund format. So that's very powerful. And we make a recommendation to consider ways to increase volume in that area for cost savings and other potential benefits. Cost reporting, I believe, is covered. We feel that you're approaching leadership within the industry. When you achieve the cost reporting project, the resolution of that, you will be in the lead, and currently you are operating in a way that is in line with industry standards in our view. And the last slide I'll skip to is secondaries, and I think this topic dovetails with the achievement of one's targeted amount of exposure for private equity, and also dovetails with a consideration that we might be approaching a market inflection point. So secondary market is something that can help you to increase your exposure to private equity. It also can help you to be opportunistic when there is a downturn in the market. And to the extent that CalSTRS can develop resources in this area, it could have those two benefits for you: a lever to increase exposure and a means of being opportunistic if the market turns. And that's all I have.
Okay, thanks, John. Any questions from board members? Tom?
On the co-investment opportunity as a way to drive costs lower and things like that, again, as we go forward, I'd be curious about a point of view about what happens in terms of the selection of a portfolio that becomes available. I think it's pretty rare when you can negotiate a co-investment term that says I can just invest in every deal this fund does. And so you get a skewed portfolio.
It's a project, really, and one part of the project is being in an open dialogue with all of your GPs to know that you have the resources and the appetite.
Right.
And you cannot necessarily call the shots on what you're allocated. In most cases, that is up to the general partner to determine. Some cases, it is specifically negotiated with the LP.
Right. And then the related thing is whether that requires different, some additional staffing of people with different skills and outlooks then, because they're picking companies, not funds, and all that sort of thing, than the way we're currently configured.
That's a worthy area of discussion. We made reference in our documents to roughly half of a staff member's time being allocated to that. You could double, triple, and quadruple that if you wanted to set a higher target of, say, 20% of capital deployment being in that format. And potentially hire persons with different sorts of backgrounds for that work.
Okay, thank you.
Thanks, Sean. Thanks, Steve. John, Chris, do we have much? I don't really, honestly, I don't know the answer to the question of do we have much co-investing going on within our private equity, or?
We do. You guys have
Okay.
slides, I think, that show the breakout of a co-investment program.
I'm just off the top. I don't. I mean,
The history's been a challenge. We've restarted it twice. And as Tom said, the challenge is the deals that get shown into us. So Margot's coming forward to talk about it.
I'd like to hear what you think, Margot. On
So we have,
Here.
staff is at $1 billion right now in NAV, so about 5% of the portfolio.
okay.
And it is performing slightly below the fund as a general, in general, but most of that is attributed to a 2-year period. But it's a whole topic for discussion.
Okay.
The PME analysis did show about, I think it was $400 million in value add just from co-invest.
Yeah, it was positive.
Can we talk about the reason why we had to restart it twice? I mean, what was the issue with having to restart it twice, or having some challenges?
The first time, well,
Is that anything
things
we
like
can talk
issues like staff turnover returns. The first time we did it in the 90s to the early 2000s, the performance was very weak. We restarted it with a different discipline, different consultants, trying to focus in on key partners and strategies. The challenge with co-investments, and as Margot said, we can spend a whole line talking about it, is the partners, we ask them all to show us in co-investments that you have to make your decision very quickly. You have to get a independent fiduciary opinion that the price they're offering to you is a fair price. And so the speed of execution, the opportunities you see make it a challenging area. It's fun for the staff because you're down in the nitty-gritty of looking at every direct deal. But every shop I've talked to that has done co-investment still continues to find it challenging because it's no fee, no carry, so it dilutes the cost of the program. If it just got the return of our partnership investments, I'd be all in favor of it. But it has been a challenge to even just hit the return of the partnerships. There are some funds that believe they can add skill, and so they're making big efforts. The Canadians, which we get a lot of press, have taken it a step further and do their own direct deals, where they're going out and trying to do these. But as Tom said, very different business structure, different incentive structure, different people. So those are all in our future and things we could talk about.
Okay.
We just got to have the right business model to execute on it.
Got it. Thanks. Anything else from the board? From the investment committee? Great. Thank you, John. Thank you, Steve. Appreciate it. All right, Chris. We're at item 15, our investment policy and management plan.
This is your overarching investment policy document. There is no investment policy that is more important than this document. So a couple of changes I want to highlight to you. The first and the largest would be on, oops, let me turn the page. I just pulled my bookmark. INV 182. So you can see all the purple there where we're deleting things. It should have been in red, but I think we ran out of red ink. What we are recommending is the list of X has gotten too long, so we need to just go to the word custom and recognize to the public we have custom benchmarks. And I want to plant a flag for you to remember on INV 182. I said it in my evaluation. I think these benchmarks are good for us to measure each asset class and to measure how we're doing, but I think they're confusing for the public to use as a way to measure how you're doing as a board. And what I think we need to adopt at the top of this is a total fund benchmark that's more a reference portfolio. so that the public can compare how they would do, how they would invest in the world versus how you're investing in the world. And that's where I got at my earlier point of retirement portfolios, the target date portfolios of 2050 or 2055, people that have that 30-year horizon like we do, 2040. How do those types of portfolios do versus your portfolio? It more would be a reference for you and for the public as our reference benchmark. We're seeing the Canadians do reference portfolios. These sub-portfolios are still more inside baseball, useful for us internally to measure how we're doing and for you to measure how the staff is doing, but I think we can adopt a better way to measure, to tell the public how we're doing as a portfolio. So those benchmark changes are all now would be ex-US coal, and so we would just reference them all as custom benchmarks. And then the other major change is on INV 89, 90, and then obviously 94, which is the inclusion of the RMS asset class and the new asset allocation steps. If you look at INV 90, that would show you the implementation process where we're recommending a step-by-step approach to implementing risk mitigating strategies. We would like to get up to 9% as quick as we can. But obviously it will depend on the managers and the market conditions. You'll notice this doesn't have years by it. And that's because we don't want to chase a calendar. We want to be investors and move when the opportunity presents itself. So we would come to you and say, okay, now it's time to move to step 2. That could be in 6 months, but it also could be in a couple of years. And I would highlight for you the inflation-sensitive asset class. Inflation sensitive, our new target is going to be 4, used to be 7. In the last 3 years, inflation has not been an issue, and we would have lost money if we had just chased inflation. So we've been diligent and proper in how we invest in that area and would ramp it up slowly. The other thing I would point out, the current target for private equity is 13. That's from the old policy, and we know that's our long-term policy, but that's not where we are today. We're at 10. And so really in private equity, we have to go from 10 to 11 to 12 and then eventually 13. Same thing there. We're going to step it up over time as we think is appropriate. So this is our implementation plan. We think we can accomplish it. You also are well aware of, as June discussed with you, the fact within global equity, we're going to be transitioning that entire portfolio to more of a global mandate. So each of these steps and each of these changes actually involves a lot of assets, north of $20 billion of the portfolio that we would be transitioning, and this would really become the big work effort for the investment staff over the next couple of years to implement this. So with that, I want to make sure you're comfortable with all those changes. You can have it as a first reading, or if you're ready, you can adopt it as a second reading. The one thing we noted is that in the description of RMS on page 194, we would now include the sub-asset class percentages, which you approved a couple hours ago.
And I also noticed we're using the language custom index now instead of like the X tobacco. And
So instead of all the X, because it would be X tobacco, firearms, Sudan, Iran, firearms illegal in California, and now ex-U.S. coal. So that's what we were recommending. And we brought this up to the compensation committee, and I think it was mentioned to you by Amy McDuffie when she reviewed all the policies. Instead of being wordy, let's just recognize their custom benchmarks. We'll put in the footnotes and in the back,
Right.
make it clear that what we're dropping out of the indexes.
sounds good. I've got Harry.
Chris, I haven't seen, the ranges are going to remain the same for each asset class?
That's what we are recommending, yes. Plus or minus 3% on all the asset classes and plus or minus 6 in global equity, which is fairly tight compared to our peers. Most of our peers use plus or minus 5. It's just sort of a textbook number. We felt that that was inappropriate. For an asset class that's only 10% of the assets, plus or minus 5 is a 50% shift in weighting, and we don't think that makes sense. So we have tighter ranges as a risk mitigating strategy.
So it's what you're recommending. I would think that you had discussions relative to what we discussed earlier in the day relative to Ms. Kim's
The shift in the global equity
Yeah,
portfolio?
that decision to make that change, that keeping that range at plus or minus 6 is the appropriate step going forward. If the range was greater or less or more, it wouldn't be more advantageous to that decision?
I don't think it would, because it's the total global equity portfolio. We're just making the shift within her equity portfolio. I think we can accomplish that within the ranges that we have in the policy.
Thank you.
Frank.
INV 182, the MSCI index, should we decide at a future point in time to divest of non-U.S. coal, that would be amended to the ex-coal?
That is correct.
Okay, thank you.
Any other questions or comments from the investment committee? So as Chris mentioned, this is a first reading, but we can it's an information item, but we can make it into an action item if we want to approve this today as written. The will of that, you want to second reading for April?
Is there any negative impact to waiting to take action till April?
Okay.
Okay, so I'd like to look a little bit more closely. This is a
Sure.
there's a lot going on in that policy revision. So one more time through it. Yeah,
So
right.
second reading,
Second reading
in April.
Yep.
Perfect. Great. Thank you, Chris. All right. Item 17, draft agenda for our April meeting, which will include the second reading of that policy. We're going to do the tactical investment on innovation, right, with Stephen Tong. What else? Let's see. Take a look at it and see if you have any comments or questions. Everyone all right? Chris, do you have any comments?
Yeah, one thing I would add to your, not add, but just highlight for everybody in the April agenda. April and September are always very long meetings. While we will start with the normal closed session discussion, obviously a highlight is going to be the semi-annual performance reports from our consultants. I think that's a really good place to emphasize and to really take a look at. We frankly should not be looking at 6-month returns. They're just, not useful with our long horizon. Doesn't mean we shouldn't look at performance every 6 months. What I recommended to you in my evaluation is that instead of big, thick books, maybe this 6-month picture should be just really a couple of pages and more of a summary. And then once a year, we get a big, thick book. But I'm going to emphasize to the consultants, as they always do, let's look at 3 and 5 years ending December 31. Let's not look at the 1 year ending December 31. We're also starting our investment beliefs project, so that's going to be kind of a discussion. If you remember, we planted a flag at the offsite. We had the initial review of those, so we'll be bringing that forward to talk about what you want to accomplish. I think that probably will take a couple of different meetings for us to get through. And then we're also bringing up under item 16, we want to come back to you. So we have a 5-year business plan on diversity. This is the end of the 5 years. There is a legislative law that requires you to adopt a long-term business plan on diversity. So we're going to renew that. Instead of a 5-year cycle, we'll just make a new long-term one. But we want to give you an idea of what we've done. You've talked about 2 of the performance areas today, global equity and in private equity, where it hasn't been what we want. And obviously, you want to continue your effort to pursue diversity in investments. What's the right way for us to do that? And we'll talk about it in April, but there won't be much time. So I recognize that we'll come back in June with more of a business plan of, okay, here's how we think at the staff level we can redo this and do this and maybe achieve better results.
Okay. Any other questions, comments about that? Great. Thanks, Chris. And I think that adjourns our open session for the investment committee, right, Brian Bartow?
Yeah, let me just visit for our stakeholders kind of the schedule for tomorrow morning so they can know what you're doing.
I was also just going to, okay, go ahead.
Before Jack,
Sure.
wait, so
Sure.
Jack, before you weigh in, I want to recognize somebody who's here with us, and he will be attending future meetings.
Yep.
I don't know if he'll be with us tomorrow, but this is a former president of the United Teachers Los Angeles, current president of the UTLA retired chapter, long distinguished career in education, advocating for students and educators across the state. John Perez, would you stand so we can recognize you, Mr. Perez?
The only other thing I was going to comment on is we did say that there would be public comment at the end, and I didn't announce that. So is there any other additional public comment before we go into closed session? Seeing none, all of you in the public, thanks for coming and joining us today.
Yeah, let me just, and I'll just mention the
Sure.
calendar for tomorrow morning for the stakeholders here. It's going to be a little bit different tomorrow. At 9 o'clock, the board is actually doing a budget workshop next door. They really wanted to dig down into our budget process, but you'll all want to be here no later than 10:30 when we start the board meeting, because we're going to kick it off with a very special item. The researchers at University of California, Berkeley will be here to present original research on CalSTRS to answer the question, are California teachers better off with a pension or a 401k? So be here for that. It's going to be one of our best items of the year.